recording because I have been known to forget to do that. There we go. So announcements to kick things off here. Spartan Journal applicants, you guys should have received an email from us like about an hour ago, but if you did not, what we did, we sent over was a link to sign up for interview times with Professor Schiestel. So this is, I put it in quotes here, interviews. So they're supposed to be really informal. We don't want you guys to like sweat over this. They're 15-minute blocks. And really what it's meant is for you guys just to kind of get to know Professor Schiestel, talk about how you guys want to add value to the Spartan Journal, and then maybe go over like behavioral questions. So what we mean by that is he might ask you something like, tell me about a time you worked on a team, or tell me about a difficulty you had working on a team, something like that. And if you're having trouble, just Google that. So nothing difficult, should be pretty easy. If anybody has any questions about that, does anybody, I guess I'll start there. Does anybody have any questions about that they want to throw out there to start? All right, doesn't look like it. So if you guys feel free to email us too if you want, feel more comfortable that way. So next one I have on here is Plant Moran opportunity. So I've been plugging this one for a while, but Plant Moran is still hiring for multiple internships and for their campus leadership events. So these are like one-day opportunities where you get to network with people outside of just wealth management as well. So these are awesome. The one internship they're still looking to fill, and hopefully it can be a Spartan, is a junior level internship in their wealth transfer department, which is in Southfield, Michigan next summer. So this is something Alex on our e-board, actually, she was a wealth transfer intern last summer. Sounds like she enjoyed it to me. So if you guys have any questions about that, feel free to reach out to her and she'll be able to answer any questions. So link to that job posting is on our job board. So yeah, and last one I have on here is the CFP study group. So we've been talking about this for a while. We'll send out another email next week, but we're going to kick this off. We're going to kick that off next Tuesday. So our general meetings end. This is our last meeting of the semester, but we're just going to meet briefly next Tuesday, roughly around the same time, try to get an idea of what we want to do as study groups. Anybody listening who's interested in getting a head start, we're thinking about using like the Kaplan series. So they have like a plan. It's worth, I think it's like $450, and it gives you the complete, all the books you need, work through them. We don't really know exactly what we want to do with all that yet. We want to meet with everybody, all the seniors, everybody who wants to study for the CFP. So we'll send out more details, but there is a registration link available for that. So awesome. So next one I have on here, I just wanted to say thank you to Claire, because I think this might be our last meeting with Claire, who is our director of recruitment this year. So Claire's been awesome. She's helped out on a lot of the social media stuff. She's helped out on the giveaways and a bunch of other things. So Claire, everybody, if we could give like a round of applause, real quick for Claire and all the hard work she's done, that'd be great. So thank you guys.
Thank you guys.
Good job, Claire.
Awesome. Yeah, next one on here. So I wanted to say congratulations to our current news team. So they're all going to be stepping into different roles next semester if they haven't already. So first, Oscar is going to be taking over Claire's role as the director of recruitment. Jake is going to be our Spartan Journal editor. He has started doing that, so you've probably seen his work out there if you've been reading. And Vincent, who's not here tonight, is our podcast producer. So you've probably heard him on some of those as well. So congratulations. So let's get another quick round of applause to those guys. Thank you. All right. Well, more from me real quick, because I'm covering from Vincent tonight because he can't be here. So Vincent's been covering this story for a while. I've been reading up on it as well. I'm sure many of you have. But Pfizer, they actually announced last Friday that they submitted a application to approval to seek authorization for their COVID-19 vaccine. So that's pretty incredible that they were able to do it so fast. It's actually going to be like the fastest American vaccine to ever seek approval. So that's pretty interesting. It looks like it's on track to start being distributed in December. So that's probably going to start with healthcare workers, frontline workers, people who are maybe higher risk. And what I've been reading is general public, it'll probably be available somewhere in the spring next year, maybe early summer. So it's 95% effective. That's pretty incredible. And the FDA will determine its safety and let us all know, all the final details shortly. So last one here, it's a 2-shot vaccine. So the first one you get, and then you get the next one 2 weeks later. So, like a lot of vaccines out there. So with that, I'm going to kick it over to Jake.
Thanks, Justin. So yeah, I did mine on the Trump administration planning to privatize Fannie Mae and Freddie Mac. So you may wonder, what are these? Who are these people? They are not people. They are companies. So what they stand for are the Federal National Mortgage Association and the Federal Home Loan Mortgage Association. And they were created to provide stability, liquidity in the mortgage market. And so what happens are homeowners buy mortgages from banks or other lenders, and Fannie and Freddie buy these mortgages and package them into mortgage-backed securities, where they sell these securities to investors and they buy them on the market. And Fannie and Freddie take on more risk than reward, and they are backed by the government, and the government takes on a bunch of their default risk. And this allows for there to be more lenders giving out loans to people in low income and I guess the middle class as well. And Fannie and Freddie back half of all new U.S. mortgages in the United States. And what Trump wants to do is privatize them, where the government doesn't have any control over what they do. And they've been in, I think the word is conservatorship. It's when they appoint, the government appoints like a new agency to oversee Fannie and Freddie because of the market crash in 2008. And now I'll pass it on to Oscar, where he will talk about interest rates.
How's it going, everybody? If you've been along for the ride this entire year, first off, thank you. It's been a great year. But when I kicked off the year, I think one of my first stories was about the Fed and their response to the COVID recession. So my title was, "Are the interest rates the cure to the COVID recession?" Just wanted to get that joke off. So basically, it was an interesting story. It was talking about how the Federal Reserve is holding fast to their near 0% interest rates. And they think that the result, like what's going to come of this, is we're going to allow enough liquidity in the market to spur enough demand until we recover. What's been interesting is the stock market and the economy are producing inconsistent results. And what you have to understand about economics is the economy and the stock market are two different entities that move in step, but are not fully joined together. So within the economy, we've been seeing, unemployment. We've been seeing a lack of demand in the middle class, less spending. But in the stock market, we're seeing all-time highs. A lot of companies are trading way higher now than they were pre-COVID. So of course, that's inconsistent, and I think that goes back to the Federal Reserve and their and what their mission has been with all this free money. They're allowing a lot of companies to maintain high levels of liquidity and keep cash on hand. If you've taken a finance class, a lot of cash moving through operations and keeping cash on hand is a good sign of a healthy company. But what's also happening at the same time is with all this cash that they're adding, they're also racking up massive amounts of debt. So one must beg the question, with this liquidity, with the stock market doing so well, are we providing a short-term solution to what is like long-term economic problems? Will these companies be able to pay back this debt? What's going to be the after effect of all these high prices? Some may say there's going to be a bubble that pops in the stock market. Some may say that the economy is going to catch up with the stock market. So I think it's going to be interesting to see how these interest rates work, because over the last 100 so years, that's been a lever that we could pull to solve a lot of issues. But this isn't something that we've done before. This COVID thing isn't something we've seen before. So we're kind of using old tricks to solve a new disease. So just keep track and keep up to date, and we'll see what happens with this thing.
Yeah, so today you guys have a treat today because we have two personal finance sections. So the first one here today is saver versus spender. So at this point, you should already know whether you're a saver or a spender. hopefully most of us are savers at this point. So some traits they have are excellent at budgeting and setting and keeping their financial goals. Like traits for like these people are, you feel good when you contribute money into your accounts and you see them grow over time. They're detailed and organized when it comes to managing their finances. And tips to consider if you're a saver are to consider your purchases as investments instead of just immediate costs, and building flexibility into your budget. And if you're a spender, you're the guy you want to go to the bar with. You're the guy that will buy everybody drinks. They're there for a good time. Um, and they value what's happening now over the future, and see money to an end. You say, I'm hungry, I want to go out to eat. They'll spend money for it. They won't think otherwise. So they tend to dip into their savings account more than they contribute. And what they need to do is set financial goals, and not take as long to anticipate them to happen. And tips for this are organizing your money into different accounts. Let's say that you are an avid gambler. You like to bet on sports games. It's good to have money set aside in a separate account for that, so you don't dip into other accounts that you have. And another way to imagine this is to think of your money as locked away and accessible, where you can't touch it. That'll keep you from spending that unnecessary money that you need to save. So yeah, now we'll pass it on to Oscar.
Okay. So this is a very common conversation that happens in the wealth management community, really the investment community overall. You'll probably hear this more going along, is the relationship between the active investor and the passive indexer. One thing you have to understand before really talking about this is efficient market hypothesis, which is basically markets are efficient and prices are random, and it's hard to predict an efficient market. And it depends on how much you believe that. And that's going to basically determine if you're an active or passive investor. The philosophy behind active investing is, your goal is to achieve higher than average returns on your portfolio. And you want to do this by using technical analysis, a lot of hands-on time and studying the market to exploit short-term price fluctuations. So you get your returns within, 1 week, 2 week swings, maybe even day trading, maybe even at the most a couple months here or there where you're actively making trades and readjusting your portfolio. The most people who commit to this hypothesis are portfolio managers, market analysts, and fund managers. So people who work at a hedge fund, people who research investment stuff, and then market analysts who are constantly watching the market, constantly looking at price fluctuations and reading charts. If you go to the next slide for me. Passive indexers is basically exactly how it sounds. They're trying to achieve slightly higher than average returns on your portfolio over a long period of time. Usually 20 years is the number a lot of people like to throw out. The emphasis here is the slightly. So we're just barely trying to beat market averages here if you're a passive indexer. We're using a buy and hold approach, where you're building a diverse portfolio through ETFs, mutual funds, and index funds. This is going to be a good segue into what we're talking about today. But using a diverse selection of different products. Of course, this is just on the equity side. You can use anything from CDs, bonds, debts, and stuff like that to build your portfolio as well. But from the equity side, we're looking to buy and hold, a large mix of different stocks over a large array of industries. And most people who stick to this ideal are retail investors who are a little bit older. I know younger investors are more active managers, but the older retail investors who are people like your dad or some of your boss at work or something like that. And then wealth managers, of course, people, CFPs, people looking to manage large portfolios with insurance, estate, and a whole bunch of other things going on where you don't even have time to actively manage. And then, of course, product designers. And what I mean by product designers, I mean people, I don't even know if this is the official phrase, but people who might work at Vanguard who produce the Vanguard ETFs, or people who produce or who work yeah, I guess, producing ETFs and stuff like that, who design products that are sold by, people like Vanguard or Schwab or something like that. And the idea here is, if we hold over a long period of time, we can achieve still pretty solid returns and please our investors or make good returns on our portfolio. But that's it for me. I just want to thank everybody for listening to these stories week over week. This has been a lot of fun for me. I've never done anything like this, and I hope you guys enjoyed the content over the last few weeks. So I think, Justin, I think you're kicking this off, so I'll pass it off to you.
Awesome. Yeah. Thanks, Oscar. Jake, I might take the screen back from you. And yeah, I mean, now that you said that, Oscar, I got to say, man, you guys have done an awesome job. I love listening to your stories every week. This was something that was new this semester that we started for the first time. You guys have knocked it out of the park, and we've listened to some awesome stories. It's really grown. So kudos to you guys. You've all done an awesome job. So sweet. So yeah, we'll kick things off, guys. I am going to get my screen ready here. Yeah, we didn't even plan the active passive investing. This is something that just so happened to line up perfectly. So, all right. So, intro to ETFs and mutual funds. I'm sure this is something that we're all a little familiar with, but we're just going to start by a quick review today, and then we are also going to open up the Investopedia stock competition. So, something I forgot to mention a little bit earlier, but. So to kick things off here, mutual fund. So what is a mutual fund? It's a pool of money collected from many investors and operated by professional managers. So Oscar was talking about active versus passive. When you're thinking for our purposes here at MSU, if you're in the CFP program, when you think about mutual funds and a lot of firms, you typically do think on the active side. They can be passive, but a lot of active managers, frankly, the mutual funds that stick around, they're the good active managers. They're the ones who take the time, they do the technical analysis, and they're the ones who do beat the market consistently, because it's a hell of a thing to do, quite frankly. It's not easy. That's why indexing and passive management, why we're going to get into here in a second, has become so popular. So what you want to do when you're researching mutual funds, a big thing is you want to check the fund's prospectus. So if you're in the program, you've probably done a mutual fund report for Professor Schiestel. And what we do in there is we dive into the fund's prospectus. And this is something you can do at your own leisure anytime. It might seem a little daunting at first, maybe like looking at a 10K for a stock, but it's really quite simple. So what you want to do on that to start is you want to just Google whatever the ticker symbol is or whatever the company is and put fund prospectuses afterward. What it's going to say right at the top is what the fund is aiming to do. So whether it's aiming to provide above average returns on high growth companies in the S&P 500. That's a really wordy answer, but it's always going to tell you right there what it is stating to do. And it's very important, because what you want to make sure, what you're checking with these mutual funds, is that these fund managers are actually doing what they're saying they're doing. So I know, we live in a world where we like to believe everybody and take it at their face value, but us in finance, we got to make sure that these managers, we got to hold them accountable. Us as financial advisors, that's how we add value to our clients. So that's something that you definitely want to start out at. Other big things about mutual funds I wanted to mention here was they usually have account minimums. So in the age of Robinhood, a lot of people think they're trading mutual funds, but really they're trading ETFs. And that's simply because most mutual funds have a minimum, whether it be $10,000, $20,000. Not every fund manager is just going to take your $10 from your Robinhood account and invest it with his pool of investors. So that's another big differentiation. Last thing here I've got on the bullet points is NAV. So another big difference between mutual funds and ETFs is mutual funds are only priced once a day. So when we get into ETFs here, we're going to see they're a lot like stocks. They're constantly being traded, hundreds of times every minute. Mutual funds are only priced at the end of the day, and they're only traded at the end of the day. So what does that mean? That means there's frankly a little bit less accuracy in the pricing when it comes to ETFs. It does happen every single day, but big thing to keep in mind here is the NAV. You're going to see a lot of statistics when you look on Morningstar and Fidelity. The NAV, the net asset value, is what you're actually going to pay at the end of the day, what the mutual fund company is pricing at the end of the day. So if you guys are seeing here, I spent a lot of time on this slide, but I'm sure you can see just on the right-hand side, this is an example of what a mutual fund would invest in. So this fund manager has taken, I can't remember what fund this is from. Oh, it's a mid-cap growth fund. And he's taken money and he's invested in all these different sectors at this different capacity. So, 35% close to technology, 22% in healthcare, and that category on the right is showing you its category. So it's a mid-cap growth. We'll get into that. But how this mutual fund compares to other similar mutual funds. So if anybody has any questions, by the way, eBoard, please, guys, just shout them out. I know I'm sharing screen, so just please stop me and feel free. So ETFs, touched on a lot of things here, and there's a lot of similarities between mutual funds and ETFs. Like a mutual fund, it's a basket of securities, a pool of money, kind of the same thing. But the big difference between the mutual fund and the ETF is it's traded on an exchange like a stock. So you can buy a mutual fund at any moment in time, but an ETF, it's being priced every single minute. It's being traded. There's people who are trading all these things back and forth, and that makes it a lot more similar to a stock than a mutual fund. Typically, these things are passives. You can see active ETFs. I was Googling it. They're really not that popular, but they are out there. But typically, when you think of ETFs, you think of passive funds. And this is because ETFs usually track an index. On the next slide, we're going to get into the details of what an index is. But an ETF, the manager of an ETF, they're typically just picking something like the S&P 500, all 500 companies, and putting it in a wrapper. They're just buying them all. They're not doing any technical analysis, any of their own opinions. They're just buying it and then selling it to us consumers. So you can see all these different differences basically on the right. I'm not going to get into them. We're going to send the slide deck out, of course, like we always do. And if you guys want to go through this at your leisure to help you, I thought this was pretty helpful. So yeah, the other big thing here I guess I want to mention is ETFs are typically lower cost and more tax efficient. So I'm kind of saying the same thing by saying lower cost. They're just cheaper on the tax side. And the reason for that is when they track indexes versus a mutual fund, they're not buying and trading stocks all the time. They're not trying to beat the market. So when you as a mutual fund manager are trying to beat a market and you're constantly buying and selling all these different securities, there's a tax implication that comes every single time with that. In ETF, if you're just buying the S&P 500, that doesn't happen. You buy all of them once. Tesla, it sounds like all these managers are going to have to buy Tesla here shortly. But other than that, there isn't a tax implication that comes along with ETFs. So. All right, so index funds. Index funds, typically these are synonymous with ETFs. That's why I kind of put them here. An index, for anybody who isn't familiar, is any kind of benchmark. So I've been talking about the S&P 500, but other popular indexes that you hear are the Dow Jones, the NASDAQ, the Russell 2000. If anybody's familiar with the investment SIA, that's what they primarily invest in, is the Russell 2000. But an index fund, it's any fund that represents a theoretical segment of the market. It can be a small company, a large company, industry, or among other things. So investing, it's like I said, it's typically done through the ETF, and it's designed to mimic the index, but ETFs also have prospectuses. So it's really important for you guys to go through and look at that and make sure that the ETF managers are also doing what they're, holding them accountable. That's what your value add is as an advisor. So over here on the right, I just have a bunch of examples of indexes. Again, you guys feel free to go through. Top ones are American indexes. Middle one is European indexes. And then the bottom one is just some, treasury indexes. So. All right. Now we're going to get into Morningstar. We're going to pop off and we're going to go into breakout rooms here in a little bit. And we're each going to dissect a fund. But the first thing I wanted to start, obviously, is give everybody the tools. So Morningstar Style Boxes, some of us seniors, we've seen these before, but the one on the left there is an equity style box. Equity, that means stocks. So if you're looking at, I'm actually going to start on the the horizontal axis there. So value, blend, and growth, these are kind of subjective, subjective categories, so to speak. Now, there are very widely accepted terms for these companies, but this isn't something that's exactly quantifiable. So, this is something you guys should do some research, look at the difference between a value company and a growth company, and then a blend is obviously a combination of the two, and you guys take your pick on what the appropriate investment is for you. So looking at the vertical axis, we've got small, medium, large. You can see the different size companies on that. And when you guys get on Morningstar, you'll be able to see how that affects and where different funds land on these different style boxes. I put the fixed income one up here as well. I'm not really going to go into that today because I know not too many of us invest in bond funds, but at least we're not doing it here today. But there's some information if you guys are interested. So. All right. I got an old logo on here. Key performance metrics. So this is something else we see on Morningstar. We're going to go into this here in a second, but the three big ones that you guys want to start looking at are alpha, beta, and Sharpe. So alpha, this is excess return relative to the benchmark. So we're going to take an index fund that's matching the S&P 500 for an example. If it had an alpha of 1.0, that means it is returning $1 extra in addition to what the S&P 500 is returning on all of its returns. So that is measuring how well that fund is performing relative to its benchmark. So beta is another very important one. It's also called systematic risk. All us finance majors, we definitely learn about that. And that is that is measuring risk or volatility relative to the market. So if you have a market beta, like the market beta is 1. So that means how well the S&P 500 is performing is 1.0. If your fund is more volatile, which means its price is jumping up and down more than the S&P 500, it's going to be higher than 1. The higher above 1.0 it goes, the higher, more volatile it is. And then the exact opposite true for a negative beta. So if you have a stock that doesn't move very well relative to the market, it doesn't move at all, you're going to get something on the negative side. So last one here is the Sharpe ratio. These are all very important, but I guess this would be the first one, I would say the snapshot you want to look at right away, because that kind of, it doesn't combine alpha and beta. That's not the best way of saying it, but in a way, what it does is it measures performance relative to risk. So it's showing you how well it's performing on the benchmark, and then also saying how well this fund, how volatile it is. So looking at these key categories here, you've got 0.06, decent, blah, blah, blah. You guys can go through each individual ones to see what's good. And we're going to go through here in the example which ones are good. But the important thing to keep in mind is you want something above 1.0. Those are the kind of funds you're looking for, something as close to as possible. Now things aren't perfect, but these are the big ratios here. So, anybody have any questions about that? No. Sweet. So I threw these on here. This is a quick snapshot. Again, this is if you guys want to look at this later and you find it confusing or maybe you forgot. So what you're going to want to do to first find the performance metric. So this is, we were talking alpha, beta, Sharpe. Go into Morningstar real quick. Actually, this is what we'll do. I'm going to stop share. Give me 1 second. I'll pull up Morningstar. I'll show you guys exactly how to do this. So, all right. So here we go on Morningstar. So we are going to be searching performance metrics. VOO. So I keep talking the S&P 500. That's just the easy one. Vanguard. Boom, boom, boom. That's what they seek to track. It's an ETF, passively managed fund. So whenever you search your symbol, you're going to come up to this screen. Unless you're paying for Morningstar, you'll get a bunch of annoying ads. But you're going to scroll through those. You're going to go right here. Here's all the different tabs. So performance metrics. We're going to go to risk here. And then we are going to change this to a 5-year. So an important thing to think about as an investment manager is your time horizon. So typically as a financial advisor, you are investing for the long term. Now, not every single client is like that, but I know, the typical advisor doesn't want to manage a portfolio of a guy who wants to trade stocks all the time, right? He can do that himself. So when you're investing from an advisor's perspective, you're looking relatively for the long term. Now, there is always exceptions for that, but the reason I'm saying all this is you do want to make sure you're considering time horizon and all this. So make sure you click 5-year. The 10-year is okay, but the 5-year is considered a better benchmark when you're looking at all these statistics. So anyway, boom. I'm sure as you guys can see, they're right here looking at you in the face. So here is the alpha right here. It's 0.4. So that means it is underperforming the S&P 500 slightly. Here's the beta. It's a 1.0. So boom, it's an index fund. It's an ETF. We love that. That means it's matching the market. That's exactly what you want to see. So after that, we've got the Sharpe ratio. So that's risk relative to return. We see that it's decent. So it's not quite a 1.0, but it is above the 0.6 mark that we were looking for. So not a bad measurement of risk. So that is how you go through on Morningstar. PowerPoint here. So next is fee structure. So I'm going to blow through these a little bit faster here, guys. I know I'm taking my sweet time. So next, fee structure, this is another big value add for us as advisors. So when we're looking at mutual funds, we're looking at ETFs, the market's become so commoditized that a lot of these, there's so many products that are so similar out there. Our job as advisors is to try to find the best one that's giving total return. So what does that mean? That means that all these returns minus the fees. So it doesn't matter if we have a big alpha or a giant Sharpe ratio. If we have to pay 3% of all of our gains out, what's the point of that? So the expense ratio is something you always want to check on an advisor. It's big value add. The last one on here is something that you don't see too much. It's a 12B1 annual marketing or distribution fee. What I would say in regards to that is if you look at the net expense ratio, which we're going to look at in a second, you see it's pretty high. Look if they have a 12B1 fee. It's not the most common thing, but if they have a high 12B1 fee, you might consider looking at some other options. So same thing here. I'm not going to click through Morningstar, but what you're going to want to do is search the fund, search the ticker symbol, click on the price tab on there, and there you're going to get all the information that you want. So first, you're going to get the net expense ratio. That's the big thing that you want to see because that's the actual fee you're paying at the end of the day. All the other fees added together. So on this fund in particular, it's 1.01. And then you can see Morningstar has all these cool tools. It's not the best. You shouldn't always use Morningstar. You should definitely rely on more than just one tool to research investment advice. But you can see compared to other similar funds, it's a little bit lower than the average. So not bad. Down here, it kind of shows you the same thing. This is important. It does show you the fund category and comparison. But what's more important here is it shows you what the expense ratio has been over time. So looking at this fund, it stayed consistent. It has, it's gone up a little bit, but it's really stayed the same. So, just another piece. These are all right here when you search for the fund. So last graph I've got here for you guys. This is the growth of 10,000 chart. This highlighted line here on the bottom is showing you what the total return is. So this is going to be the return of the NAV, right? The return of the fund return of the fund minus the expenses relative to the benchmark. So what we're seeing here is you've got, this fund in different years has done pretty well. So wordy way of saying that this is an ETF. This is actually, you can see by the graph here, it's actually done a pretty good job of matching its category. If you're looking at the line graphs up there, and that's what you want to see for an ETF, that it's matching the index that it's shooting for. So definitely do your research in the prospectus, but these are other little ways that you can look at graphs and be like, okay, I can see that there's the S&P, there's the fund, we're on the same page there. So. Awesome. So we are going to do a bit of a case study there. I guess before we do that, does anybody else have any questions before we kind of dive in and we all go into breakout rooms and do different questions and stuff?
I don't have any questions, but I enjoyed that presentation, Justin. Good job.
Oh, thanks, Gusta. Wasn't too long-winded. We lost a few, but no big deal. Sweet. So actually, I want to take a poll here too. Do we want to do breakout rooms for this from the people who are still here? Can I get a thumbs up from people who want to continue with the breakout rooms? Okay. I see 1. Yep. 2, 3. Sweet. I see a couple. Okay. I'm getting a few here. So we're gonna go with breakout rooms. Awesome. Sweet. We're gonna start the case study, and then I'll put everybody in breakout rooms, and we'll each take a fun. So first thing here, John and Jane Spartan, they're new clients of yours. You guys just graduated, you got your CFP, and you got your first clients here. So these are a couple guys, John and Jane. You knew them from college. They struck it rich, and now they're looking to meet their long-term needs and goals. So what they came to you with is a super simple financial plan. They just want to know, they want to pick a mutual fund. So they've come to you with a list of mutual funds, and they want to figure out what the best one is for their long-term goals. So we've got 4 funds here. I don't know if you guys want to, we'll go into the breakout rooms. I'll assign, when I assign breakout rooms, we'll assign everybody a fund. So you guys don't sit tight, and we'll do that. So first one, fund analysis. So this is something I threw together here when you guys are going through this at your own pace. These are maybe some of the questions you should be asking yourself. This was the way I approached the analysis. This is the way that I threw together these funds and all the information you guys are about to see on those 4 funds, and just the order I do it. The reason I highlighted these first 3 is these are things that I actually typically don't do on Morningstar. The fund objective, like I said, I usually look for that in the prospectus, but that's something that's really easy. Frankly, if you just Google something, you'll be able to see what it's about, what it's trying to do. The next one is investment manager philosophy and process. Morningstar makes you pay for that, so I don't do that on Morningstar. You can find that in so many other places for free. And then the management team. So Morningstar, as well, it's on there, but it might be better to look on maybe Yahoo Finance, not Fidelity, Yahoo Finance or Google or some of these other places. And what you're looking for is how long the manager has been there. Has the manager been there a year? Did they just start this year? Have they been there, since 1998? So, those are the kind of things you want to look for there. Everything else we kind of covered. This is just a general go through. We already have gone through how you find all those things, but this is a good slide when you guys are doing your own run-throughs. So first one, we're going to do TWHIX. I'm going to stop sharing here for a second, pull up Morningstar again. Just give me a second. TWHIX. So, okay, so American Century Heritage Fund. Let's see. So I'm going to do the dual screen here for you guys. I apologize if it's too small for all of you, but this is going to help me while I go through. So we're just going to run through all these together. And then these other slides, this is where I'm going to put everybody in breakout rooms. So first thing here, like I said, some of these bullet points I Googled. So focuses on long-term capital growth by investing in mid-sized, high-growth companies. So that was something I pulled right out of their prospectus. You can find that on Yahoo Finance as well. It's managed by American Century Investments. That's very easy to find on Google. And I actually found that this is a newer management team. They just started in 2018. So, pretty new. I noticed the managers, they had some experience investing in other funds and other places, but, newer on the fund, I guess I'm a little skeptical, I'll just say it. So the holdings, they do roughly match the investment strategy. They hold a little bit more large cap than their category. So how did I find that out? We can look right here on Morningstar and we can see. So let's do. All right. So Morningstar Style Boxes, as we went over, we can see this the right. I'm going to blow this up here so we can see it a little bit better. But the blue dot, that represents the American fund. So that's the fund that we're looking at. You can see here on the Style Box, it's considered a mid-cap growth company. And then these other two things you want to keep in mind are it's measuring itself against the Russell Mid-Cap Growth Index. So there's a million indexes out there, guys. You guys are going to have to Google each one because I can't think of them all off the top of my head. But they will always have what they're measuring themselves against right here. So we can see that it's investing slightly more large cap companies than mid cap companies. Not a big deal. That doesn't concern me personally too much. And then the yellow dot here, that just shows you similar funds in the category. So we can see they're all pretty close. So we the other piece that we've got here is that they have 84 holdings. So that's something we can see here on, I believe it's this same page of Morningstar. Yep. So right down here, if you just scroll down on Morningstar, it says holdings. How easy. They've got equity holdings, and then you also want to just make sure you go over and look to see if they have any bond holdings or other holdings. So 84 holdings in this fund. Turnover ratio, like I didn't highlight that, but that's something too you guys could keep in mind. High turnover ratio means they're buying and selling funds a lot. I don't know if you guys want that in your ETF, maybe more in your actively managed fund. So that's for you guys to decide. All right, other big things here that we had mentioned. So this is these are the big categories that it invests in. Mostly technology. We see, yep, just about 22% here. Next we have healthcare, so about 35%. Didn't update my slide, so for that I apologize. Oh, actually, nope, I'm right. Never mind. I had it backwards. So these are right. And then consumer cyclical. So we can see that these things are right here. You can go, break it down by country, but really the important thing is sector there. So next we're going to look at price real quick, and we're just going to check out the net expense ratio. This was actually the fund I used in my slide, so this should look familiar, hopefully, once the ad goes away. But boom, this is the page. There it is, right in front of you, net expense ratio. And then you just want to look over here to make sure if there are any other fees. So most of this is coming from the management fee. So we can probably surmise from that as an active managed mutual fund. That's where their value add is, trying to beat their benchmark. That's why it costs a little bit more. So awesome. Then last one here, we're just going to look at these risk performances. So that's alpha, beta, and Sharpe ratio. So you guys can see these here. I went through them on the slides, but just so you could see them on Morningstar. Here they are. So if we go to the 5-year, we can see that this fund is a slight outperformance of the benchmark. The beta, it is a little bit more volatile than the market. That's not too much. And then the Sharpe ratio, it's a decent Sharpe ratio. So compared to the risk that you're getting, it's a decent performance on this fund. So awesome. So, all right, give me a second here, guys. I know people scared of the case study. So I'm gonna split us up still into breakout rooms. E-board, anybody have any questions or anything? Feel free to shout them out because it's gonna take me just a second. But I'm gonna put us all.
Justin, can you put Nick Nowakowski in my breakout room if possible, please?
Absolutely, I can.
Thank you.
So I hope you guys learned a lot, and it wasn't too much like a class. But let's see.
Damn, there's more e-board and news team here with like 4 members. We got Miles, Nick, Matt, and Rachel. Beautiful. Mitchell over there.
Okay. Boom. We're actually good. So, all right, guys, should all be open. Sweet.